Assalamu alaikum friends, welcome to lecture 15 of AFM, which is section D. This is a new section for AFM, and this was not explained in your financial management. So this is something which will be a little new for you, but trust me, this is just the opposite of acquisition and merger, right? Previously we have just finished acquisition and merger, lecture 10 to 14. So this is just the opposite of it. In this section we have two lecture 15 and 16. Okay, this is about financial reconstruction. The next one will be business reorganization. Now in this lecture we are going to focus on options for solvent companies. See, there are two types of companies that can do reconstruction. It's not always necessary that is always solvent. The ones who are failing, okay, a failing company and a solvent company. The options that is available for failing company that want to restructure and solving company is different. Okay, but our focus will be on the solvent company. Then what is the impact on the stakeholders of restructuring or reconstruction? Then we have to assess the impact of the reconstruction scheme in your AFM exam. Okay, they will give you more than one scheme, two scheme, or three scheme. You have to show the effect of all this on the statement of financial position and the earnings, total or earnings per share. They will give you one statement of financial position, and with the reconstruction scheme you have to show the impact. We are going at the end of this lecture we are going to do questions, and those questions are very important. So make sure that you watch this lecture till the end to know how a question on reconstruction can come. Okay, often reconstruction question comes in your FM exam as a 50 marks question. Yes, but it can come as a 25 marks question also. But most of the time it came as a 50 marks question. That shows this topic is very important. Okay, I also got this question during my time, as I think it was as a 25 marks question. Okay, but remember, even though this is a new topic, but whatever things you have studied from your valuation of when you value a company, right, or your WACC, asset beta, equity beta, all those things, the knowledge of all those things is relevant here also. Okay, that you have to know. So now, what is restructuring? Yeah, for doing to show the impact of statement of financial position and EPS, we follow tabular method. I'm going to tell you the method that you have to follow, and then we'll do the question at the end. Now, what is the meaning of corporate reconstruction or reorganization? What is the meaning of it? First, understand the meaning without going to the topic. See, reorganization means there could be, for example, your company is not is in losses, right? You currently have so many loans on which you have to pay interest. So because now you're facing losses, you might not be able to pay the interest to the debt holders. You might have to give dividends to the shareholders, which cannot happen because you are in the losses. That means you cannot give dividends. So because of this, in order to improve the company from loss making to a profit making, what do? Company change the organization of this, how their debts and equity are organized. They change the structure of it. For example, earlier you are having, let's say, one equity and you are having three different types of debt. But now you can understand that since your company is not doing well, you will change the structure of it. How? You can change your structure of a company in these four ways. Okay, you can change your debt to equity. Changing your debt to equity means now you don't have to pay interest on those loans. You can reduce your financial risk. Second, you can convert equity to debt, maybe in order to reduce our WACC, because we know debt are tax deductible. Because of debt, you can save on tax. Okay, or if it's an equity, you can convert that equity from one form to another. There are so many forms of equity. We know that. Definitely, we are going to do a question on each of this. Don't worry. Or conversion of one debt to another. Maybe from unsecured loan, you are going to a secured loan. You understanding? So this is one way of, so these are the 4 ways that you can do reconstruction in a company. Okay, reorganization. You reorganize how your debt and equity are in the portfolio of the company. That is the meaning of restructuring. And this often we do when the company is not doing good. But it does not mean that we always do it when the company is failing only. No, we can do it. These options are available for solvent companies. When you are solvent also you want to change. Why? Maybe you want to reduce your cost somewhere. Maybe you feel your back is very high. You want to reduce it by changing equity to debt. Maybe you feel you are paying so much of interest to the debt holders to better change it to equity. Maybe you feel one form of equity will is better than another, so you change from one form of equity to another form. Or you might want to now move to cheaper finance, so you change your debt from one form to another. It could be any reason. Okay, but mostly you have to understand that how change to another could have an impact on your financial result in your financial statement. That is the important thing. Okay, and in terms of compared to other areas, let me tell you, this area is not performed so good in terms of other areas like acquisition, merger, your risk management, your net present value. This part of the syllabus is poorly done. It's not done so well. The reason is because maybe this is a new thing which you have not gone through in your financial management, or maybe it looks a little confusing for students. I don't know what could be, anything could be a reason, but according to me, what I feel is that most of the students do not do as many questions on this area as they focus on the other areas like net present value or your currency risk, interest rate risk, or even acquisition merger valuation also they will do somewhat. But this area they often do not pay so much of attention, which should not be the thing. You have to pay equal attention to all the areas. Okay. But this is the very smallest area in your AFM syllabus. Trust me on this. That's why this is the last part also I'm touching. Obviously, before section A, because section A is mostly, I can quickly finish it. This requires calculation. So yeah. Now, let us move on to the explanation. When you want to change, what are the reasons why you want to change from debt to equity? The reasons are number one. See, you have to write also. Okay, this is not a calculation. That's why I have included this point. Otherwise, I could have skipped this point. So the reason is in order to increase your equity base. Let's say you are already financed by too much of debt. Okay, you are financed using short-term borrowings. Now you have a problem with the bank. You cannot take as many loan as you want, or even your overdraft limit is over. So what do? It's better you change your equity debt to equity. Otherwise, you have to pay so much of interest. You will run into working capital problems. Issues will be there. Your liabilities will be more than your assets. Okay, you can understand your gearing will go up if you keep on taking debt. So change debt to equity, reduce your gearing. Okay, one way is you can issue new shares, maybe right issue. Then, why equity to debt? One reason is from the tax point of view, as I told you, you can save on tax because the dividends, if you are having equity, you have to pay dividend. Dividend comes after paying tax. So you're not going to save any tax by having more equity, but having more debt will save your tax because interest you deduct before tax, and interest only comes when you're having debt, which reduces your taxable profit. That means low tax. Now, but from the legal point of view, if you convert the preference share into debenture, that means into debt, your capital reduces, isn't it? Now, conversion of equity from one form to another. Simplify. This could be because you want to simplify the capital structure. Say, rather than having 5 6 types of equity, bring it down to 1 or 2 types. It's easier to deal with if you're having less classes of share capital. Okay. Now, conversion of debt to another form. There are 3 reasons. One is security. You are becoming, for example, if you are relying too heavily, right, on creditors giving you credit or overdraft facility, okay, they do not give you any security. You understanding? But if you are going for, let's say, debenture, okay, in this case, using debenture rather than going for short term, if you want to finance a company, let's say, and you are going for a short term finance, like taking credit from the creditors or overdraft facilities from the bank, you are running the risk of breaching the covenant of the bank, because you want to finance for a long term but you are using short term. It's not giving you enough security. But if you go for a debenture, in this case, it will give you a security that is more satisfactory in this case, because you want to finance a company. For financing a company is it's a long term. You need a long term investment. Debenture, for example. So you can change from overdraft to debenture, or if you're taking a credit from creditor, you can change to debenture or any long term source of finance. That will give you more security. Second reason is flexibility. If you're having short term borrowing, you do not have so much of flexibility. Okay, but it can be improved by having long term finance or permanent type of financing, right? Because in short term, if you want to extend it more, you cannot. You have to take another source of finance, another source of, rather than having one long term source of finance, you might have to have 3 4 short term sources of finance. You might have to rely on 3 4 short term borrowings, which is more risky. You are taking a loan also, short term loan, you are taking credit from creditors also, you are taking an overdraft facilities also. Rather than having all these three separately, have one debenture. Then cost. Yes, you might want to change from having a high expensive type of finance to cheap finance. For example, you are moving from unsecured loans to secured loans, right? So these three are the reasons. Now, what is the impact on stakeholders? At the end, always ask this question. Even if you're doing this restructuring, what is the impact on stakeholders? Three main stakeholders are there. Even in your AFM exam, you have to write this. One is ordinary shareholders, one is preference shareholder, the other one is the creditor, the banks and all the other type of creditors. It could be anything. You might have venture capital is there. You might have trade payables. You might have debenture holders, depending on the question that is given to you. Okay, I will show you at the end how to do a question. Full-fledged exam style question only will do. Now, different stakeholder requirements. Remember, different stakeholder requires different things from this restructuring. If it's a solvent company, why do they enter into reconstruction scheme? So that they can improve the ability to raise finance in the future by making security in the company more attractive. Okay. This view is mostly the view taken of the scheme by banks and investor. Here is more important, because they are the one who has to give you the finance. So if you are attractive for them by having this corporate restructuring scheme, reconstruction scheme is good for them. They want to see this, that their views are taken into your reconstruction scheme. We have various ways to restructure an organization. Understand this. Debt to equity, equity to debt, equity to another equity, debt to another equity, 4 ways. Okay, so any way you can make it, but you have to make sure that you take the views of the bank into account when you are making up that reconstruction scheme. The good thing is, in your AFM exam, you don't have to create the reconstruction scheme. They will always give you the reconstruction scheme. You just have to show the impact on the financial statements. Okay. Second, if it's a failing company, remember whose requirement you have to take into account? Ordinary shareholders. Why? Because whenever the company is failing or going into liquidation, who is suffering the most? It is the ordinary shareholders. Why? Because if you go by the hierarchy of payment, okay, they are the last. Sometimes they receive something, sometimes they receive nothing. They are the last to get the payment, right? Then for preference share, okay, what do preference share do? They normally give you a right to repayment of capital on a winding up. Some preferential right is given to them, to the preference shareholders. They might receive something when the company is winding up. But remember, they are still losing something, okay, but that loss is still less than the ordinary shareholder, because in the hierarchy, before ordinary shareholders, preference shareholders comes, they will receive first. Ordinary shareholders at the end, whatever is left only they will receive, if something is left, otherwise they will not receive anything, right? So sometimes preference shareholder, what do? They agree, okay, to forego the dividend also, because they think that this scheme that they have come up with, reconstruction scheme the company has come up with, will later lead them to get the dividends back. They can get their dividends back later on, but right now they are foregoing the dividend. Okay, it could happen. That's why for preference shareholders also you have to take their views into the account when you are setting up that reconstruction scheme. Then if preference shareholders are expected to suffer, okay, there will be some reduction in the nominal value of their capital. Okay, they may require an increase in the rate of their dividend then, or share in equity, which will give them a stake in any future profit. Because they are suffering that loss, they want a compensation. Now they want a stake in any future profit, right? Then creditor, for them, what is the requirement? See, for them, okay, they will accept any reduction in their claim, okay, because when they are claiming against the company, maybe it is reduced what they are claiming to. They might receive less than what they have, what they are actually entitled to. They've accepted it. Only if they can anticipate or they can predict that in the future, because of this reconstruction scheme, if you can satisfy them that they are going to get their full payment. Sorry, I mean, if they anticipate that full repayment will not be received on liquidation, okay, so if they're liquidating, they might not receive the full repayment. But if they go by the reconstruction scheme, at least something they will receive, even if it's reduced. Rather than receiving nothing, something is better, right? So in order to do that, okay, an incentive may be given in a form of an equity stake. You might give an equity stake to creditors in the company. You are saying because they are accepting less, they are accepting, or they agree to have a reduced their claim, you are giving them an equity stake in the company as a compensation. Okay, you don't have to memorize all this thing, I'm just telling you. In addition, trade creditors may also agree to a reduction if they wish to protect a company which will continue to be a customer to them. Right, rather than demanding full payment, because they know, creditors know, if they demand full payment from the company will not be able to pay. At the end, company will become liquidated or wind up. So rather than doing that, rather than letting the company wind up, trade creditors will, okay, will accept the reduced payment, okay, but we'll have a stake in the company, we'll have equities in that company. Understanding? So you will give them some equity stake in the company. Now, assessing the impact of the reconstruction scheme. The example above, what did they show? That reconstruction scheme is to look at the likely impact on this major stakeholder. All this decision that they have taken to change equity to debt, debt to equity, is based on what is the impact on the major stakeholders. Understanding? In order to do this effectively, okay, it is useful to assess the likely impact of the scheme on the company's forecast. Number one is on the statement of financial position. Number two is on the earnings. Whatever the reconstruction scheme should have impact on these two things, and you have to show that impact in the exam. Mostly, reconstruction questions are like this: impact on these two places. Sometimes they will tell you to calculate gearing position also. So make sure that you know all the types of ratios. Okay. Now, to do that, I was talking about a tabular method that you have to do it. Okay. What is this tabular method? There are 7 steps that you need to follow to show that impact. Step 1. First, you set up a table. No need to set up a table, because now you can do this question on Excel. I will show you in Excel, and I will manually show you, and then I will show you in Excel also a reconstruction question. Okay. So you set up a table with the current forecasted earnings and statement of financial position in the first column. This will be given to you already in the exam. Okay. On the right hand side of it, okay, depending on how many reconstruction schemes you have, if you have two or if you have three, if you have two, let's say, then you draw two additional columns and show on the right hand side only the forecasted earnings under the two reconstruction scheme and the statement of financial position, all the balance. I will show you a question, don't worry, we'll do a question using all the 7 steps. Step 2, when you're dealing with the reconstruction scheme, each scheme needs to be dealt differently, okay, and start with that which sounds very straightforward. For example, let us go to step 3. Okay, let's say one of the reconstruction scheme is to increase debt finance by 5 million. Isn't it easy? Why? Because in your statement of financial position, you just have to add 5 million to your non-current liabilities and update this figure in the correct column. That means under the correct reconstruction scheme. Then step 4 is what? This is more tricky part. Okay, here you have to do adjustments to earnings. For example, because of that higher amount of debt, now you have to pay more interest, right? Pay more interest means it will affect your earnings because interest is an expense, it goes to your statement of profit and loss. You understanding? Second, generating more income from assets purchased. Let's say if you're generating more income, it should be identified in step 3. Step 3 means that is the easy part, no? Income from assets. So you increase the income, you increase the asset. Generating less income because assets have been disposed of. Let's say you have disposed of assets. Because of this, now you're generating less income. Okay. Identified in step 3. So all these things will have a tricky part to it also. Because you have to show the impact on somewhere else also. In the statement of profit and loss. Or you might have to say that you have to pay more interest. Or you are saving interest. Step 5. Now you calculate the revised forecast earnings. Okay. After you have done all the adjustments in step 4, calculate the revised forecast earnings figure in step 4 and adjust. Remember, adjust the forecast retained earnings. Retained earnings needs to be changed. Okay. In your statement of financial position, it will be under reserves. Step 6, you balance your statement financial position. You have to balance it off by entering anything. How do you balance it? That balancing figure is still unknown. It is that balancing figure. It's a balancing figure. Okay. And step 7, repeat step 3 to 6 for each reconstruction options. Okay. Now before we summarize, let us do questions on reconstructions. First we'll do it manually, then we'll be doing it on the Excel. Test your understanding 5. Okay, this question via construction case study has 3 parts to it. Okay, so in first part, let's see. Here he has been suffering losses in the last 3 years. Okay, and statement of financial position has been given to you. Sales has been particularly difficult to achieve in the current year. And inventory levels are very high. Interest has not been paid for the 2 years. Debenture holders have demanded a scheme of reconstruction or liquidation of the company. Either you liquidate the company or you change or you come up with some scheme. So here you are required show the likely position of the key stakeholders, that is ordinary shareholders, preference shareholders and debenture holders if the firm goes into liquidation. Assume that investment is sold at the current market price 60,000, 10% of receivables are to be written off, remaining assets are professionally valued as this. Okay, so now how do you start this question? Tell me. See, even if they ask for the position of the key stakeholders of this, without doing this calculation, you cannot show the position. It's not possible, right? So how do you start this question? You have been given the statement of financial position. Okay, so show the impact here. Okay, this statement of financial position that is given to is without reconstruction scheme before. After reconstruction scheme, what is this? Next to it only I will write the answer rather than making a full statement of financial position. So we'll start in the order that is given. For inventory, sorry, for land and buildings, how much it will be? Here they have given 80,000 for land, 80,000 for building. So if you add up, it's 190,000. So here it will be 190,000. Equipment, how much is equipment? Equipment is 30,000. Okay, so for non-current liabilities, they have added up. Okay, 30,000. You can put 30,000 here. How they have showed, they have added up that 130 also with 160. That's why it's 190 for non-current, but we'll write it 160 because 80,000 plus 80,000. And for investment, there is no investment. And then inventory and work in progress is. So the total non-current liabilities will be 190,000. Now coming to inventory, it is 50,000. Okay, I will write here. What about receivable? Investment, see there is no change in okay, investment is 27,000. Here they told investment is to be sold at the current market price of 60,000. So here investment will be 60,000, the value of investment 60,000. Just so don't write the value of this yet. Okay, 60,000. Receivable, what about receivable? For receivable, they told 10% of receivables are to be written off. So take 10% of this, which will be 7692, which will be 7069.2. Okay, this needs to be deducted from this. 7692 minus 7069.2. How much? Calculate and tell me. Do this question while I'm doing it. Or you can even round up to whole number if you want. 7069 also you can give it. Let me also calculate. Six three 63623. Now what else? The total you can find out, right? Total, do it yourself and find out. coming to what? Don't touch this part now, leave it and go to non-current liabilities. Regarding non-current liabilities, they have not given anything. Okay, so you'll be having all those here. Debenture 80,000 will be 80,000. Overdraft will be overdraft. You'll be having this. Interest, you'll be having this. This also you'll be having all this. Okay, so this is the total. So now what you have to do, add up all your non-current and current assets. Okay, add up all your current and non-current assets and deduct your payables, all your payables and debentures from it, and tell me the value. 160 plus 160,000 plus 30,000 plus 60,000 plus 50,000 plus 63,623. Keep it on one side and deduct all your liabilities. That is overdraft, interest, trade payables, and debenture. 4 liabilities are there. And tell me what is the value. Okay, see. Now, when you add up all your assets, okay, from there you deduct your debenture. First you deduct your debenture. Okay, because it's a secured debt. When you are taking your deduction of debt, first deduct this 80,000 from your assets. Then what? Okay, let me tell you what is the total value of assets. Okay, all your current and non-current assets. Total asset add up to 363,623. From here you are deducting your 80,000 debenture because it's a secured debt. Always secured debt is deducted first. 283,623. Then your total debt liability is this. Okay. Now how much goes to the shareholders? Just deduct 161,760. It's 121,603. This is available to shareholders. 121,863. This goes to shareholders. Available to shareholders, but they didn't say to whom. Okay, right. Now you have to explain because the question asked. Likely position of the key stakeholders, ordinary preference and debenture if the firm goes into liquidation. Okay. So who will get the payment first? Tell me the order. First, it is the debenture holder. Second, it is the preference. Third, it is the ordinary. So when you are start talking about debenture holders first. They will get the payment first. So for debenture holders, they can be sure of their capital repayment on a liquidation. That means they can be sure of their interest. Okay, on a liquidation, they can be sure of the interest. They are going to get the interest. What about the preference shareholder? What about the preference shareholder? Preference shareholder is 70,000. They will receive this much of payment. So out of this 121, 70,000 will go to preference shareholder. What is left? 51,863, right? The leftover is 51,863. For debenture holders, this will go. This 80,000 they will get. 70,000 preference shareholders will get. And balance 51,863 will go to ordinary shareholders. Okay. Now, next question, which is part 2 of the same question. So during a meeting of the shareholders and directors, it was decided to carry out a scheme of internal reconstruction. The following scheme has been proposed. Even in your exam, actual exam, AFM exam, this is how they will give you the schemes. Okay, following scheme. Okay. The last. Okay. They have given information about tax and all those things. Okay. Each ordinary share is to be redesigned as a share of 25 cents. Okay. Second, existing 70,000 preference are to be exchanged for a new issue of 35,000 8% cumulative preference share. And $1 each and 140 ordinary share 25 cents each. They are changing the 70,000 preference share to two things, two classes. 35,000, 8% as preference share. Okay, 25 cents each, 100 into 140,000 ordinary share. So I will show you. It was just preference share before. Now they are breaking down into two, preference and ordinary. They are having two classes of shares. It can happen, right? Restructuring can happen. Take this also. Sometimes two can become one. This is also possible. Ordinary shareholders are to accept a reduction in the nominal value of their shares from 1 cent to 25 cents. Yes, this also can happen. You can reduce it and subscribe a new issue on the basis of 1:1 for at a price of 30 cents per share. This looks a little complicated, but don't worry. Through the question, we'll understand one by one. I will go a little slow. Okay. Debenture holders are to accept 20,000 ordinary shares or 25 cents each. So you are changing debt to equity. It is agreed that the value of the interest liability is equivalent to the nominal value. Interest liability is equivalent to the nominal value of the shares. Interest is to be increased to 9.5%, and the repayment due is deferred for 3 years. Further, 9,000 of this 9.5% debenture is to be issued and taken up by the existing holders. Profit and loss account balance is to be written off. Bank overdraft is to be repaid. It is expected that due to refinancing, operating profits will be earned at a rate of 50,000 per year after depreciation but before interest and tax. Corporation is 21%. Prepare the statement of financial position, assuming that the proposed reconstruction has just undertaken. Okay, so let's do that. In your actual AFM exam, you will never be asked to prepare full financial statements, don't worry. Okay, you will only be either told to be shown extracts, okay, or another place where you will be told to draw full financial statement is when you have to show the impact of the changes in the reconstruction. Let's say, what is the position of your gearing or EPS after 2-3 reconstruction scheme? This is not this type of question, that is another type of question, for which we have to use a tabular method that I have just mentioned. Okay, but since here they have told us to prepare the full statement of financial position, I will do it so that you will know how a reconstruction will have an impact on it. Okay, what are the areas where you need to adjust? Okay, so here you have already been given here. Okay, so what am I going to do? I am not going to make a full this thing on here. Only I'm going to show you the balance, but I'm going to first erase the previous ones. Okay, because this is a new question, so I'm going to erase the previous figures to put the new figures there. As I'm doing it, you also do it. Take some paper or in your book or anywhere. If you are using OneNote, you can do it on your OneNote also. Okay. So we'll start with the first. Land, buildings and equipment. Okay. The way it is given. So we can already use this figure. Okay. Remember, after this, only you can do this one. Okay. Because this is continuing with the information from the previous test understanding. That is 1. So it is on that figure that you will be having. Now, that means after reconstruction, land will be 80,000. Okay, I'll write the figure inside. I think it's better. Equipment, they have already given you this figure from test understanding 1. I'm rewriting it again. Investment, 30,000. Sorry, equipment. Equipment is 30,000. I think equipment, wait, I've written the answer, but yeah, equipment is 30,000. Regarding investment, you don't have to write it because you have sold it off. Okay. And yes, I think I did one mistake in test understanding. Test understanding 5. That is the one which I've done it because I've taken investment also. I think there that they have sold for 60, all those things, because I have added up all the assets and deducted liabilities, because the question was show the likely position on the key stakeholders if the firm goes into liquidation. That is without the reconstruction. Okay, so I've just taken all the assets. That's why investment was there, because when you are selling this investment, the 60,000 comes there as a cash. That's why we have taken that there as assets, because you might be thinking investment was sold or why it is there. We basically want to know what is the this is not restructuring plan. Okay, this is just that they have given you the value. After this, what would be the impact if the company goes into liquidation? The restructuring plan starts from the next question that we are just now doing. Okay, this is not a restructuring question. This is without that. So that is the only thing, but it will not affect your entire answer. Okay, that is the only difference I wanted to tell. But even with restructuring, this land and building equipment investment will not get affected. Okay, these are the values only. Coming to the inventory, it was 50,000. Even this didn't get affected. Okay, receivable will be as it was 63, 623. But we'll be having a cash here now, which requires a working. That we'll do at the end. Okay. So mostly the changes that will occur here is this area. for the restructuring. Your ordinary shares will change. Your preference share will change. Right? You will have another account that is known as share premium account if you are paying more than the ordinary share, right? I think somewhere the interest went up or the prices went up, right? So you'll be having a share premium account. We'll write here. Which is working too. This requires a working. All this requires a working. They come as working too. Even your preference share will change. Ordinary share will change. Then capital reconstruction account is there. That is a balancing figure. You'll be having a balancing figure, don't worry. That is named as capital reconstruction. Because of this reconstruction, you are having a balancing figure. See, if you cannot balance your balance sheet, some balance will be there, okay, put it under capital reconstruction account, because it is because of this reconstruction that your account is not balancing. Okay, this is a balancing figure. Then your non-current liabilities and current liabilities. Okay, so let us first do the working for cash. Okay, for that you have to go here and see what are the places where it is affecting our cash. For example, the first one, each ordinary share is to be redesigned as a share of 25 cents. The first one will not affect your cash. It is only shares. Second, existing preference shareholders will be changed to cumulative and ordinary shareholders. Second one also will not affect your share or cash. Will it? Think. No. Third, the ordinary shareholders are to accept a reduction in the nominal value of their shares from 1 to 25 cents. Okay, that will not affect, that will only reduce your shares, and subscribe a new issue on the basis 1-for-1 at a price of 30 cents per share. Now this will affect your cash or not. When you're issuing a new share, price at 30 cents per share, this will affect your cash. This will affect your, this new share issue will affect your cash. So we'll keep this in mind. Go to the fourth. Debenture holders are to accept 20,000 ordinary shares at 25 cents. It is agreed that the value of the interest is equivalent to the value of the shares. Interest is okay. A further of 9,000 of this debentures to be issued. Further of 9,000. All these things will not affect your cash, but this further 9,000 debenture that you are adding will affect your cash. You are taking a new debenture of 9,000. That means you are receiving more cash of 9,000. So this will affect your cash. Yes, 9,000 has to be added. Then what else? When you're selling your investment for 60,000, this comes from your test understanding 5, the previous question. Investment is to be sold at the current market price of 60,000. This will affect your cash. Okay, and they told bank overdraft is to be repaid. Sixth one will affect your cash. This will be deducted. Okay, so now this four things will affect: new share issue, new debenture, sale of investment, overdraft. Four areas will affect your cash. Okay, This is the best way to do a question because this saves a lot of time. You know what are the places you are looking for. So first one, ordinary share. You first have to find the number of shares because they told 30 cents per share. How many shares are there? You have to go here and see. How many shares? 200,000 shares. Out of this, 30 cents you're issuing. That means you're receiving in cash. So we'll go here. And new share issue. 200,000 into 30 cents. That means 0.3, which will give you 60,000 in cash. Next, we have new debenture. We are taking on new debentures of how much? 9,000. Then we are selling investment and receiving cash of how much? 60,000. So it will give you 129,000 in total. From here, you have to deduct your overdraft because they told all overdraft will be repaid. What is the overdraft? Go to statement of financial position and see the overdraft. 36,713. This is your overdraft, isn't it? This will be repaid. 36,713. So it is 92,287. This is your cash. This is your cash, which you will record here. 92,287. Understand? So here you will get a total of 190,000 because 80 plus 80 plus 13, 190,000. Okay. Add only the numbers in red. Okay, that I have added. Current assets, if you add your inventory, receivable, and cash, will be 205, 910. The total will be 395, 910. Understanding? Now, working number 2. Shareholdings. Always label your workings, okay? Here you have to make columns. Here you have to make a column. You have to be very careful. First, I'll erase the previous ones. You need a big space for this. Okay, so ordinary number in terms of amount. I'll put it in terms of column so that it's more easier. Then we have preference in terms of number, in terms of dollar. Then we have share premium. Share premium only in dollar. Okay, starting with statement of financial position first. Per statement of financial position. What is it? 200,000 was the share. Price also it will be 200,000 because it was for $1. It's given there in the statement of financial position. Regarding preference share, if you see here, it is 70,000. Okay, $1. So 70,000 you have to write. Share premium, nothing will be there because opening balance is not there for share premium. Then redesignation, that means redesign after you have changed. Okay. How much? See, when you redesign it, what did they told? This starts from the first. each ordinary share is to be redesignated as a share of 25 cents. As a 25 cents. As a 25 cents of what? Of 200,000. Remember 200,000 shares. So from $1 it is becoming as 25 cents. Okay. On this 200,000 only, you are taking 25 cents, which will be 50,000. So number will be 200,000, but it will be 25 cents into 200,000, which will be 50,000. Okay. It will only affect your ordinary shares. Next, exchange. This is your first. I'm giving numbers here so that it becomes easier for you to tell which point am I using from here. This numbers only I'm using. Okay. 2. Here you are exchanging. You're changing your 70,000 to 35,000 preference and 140,000 ordinary shares of 25 cents each. Okay. So let's do that. Now you will have 140,000 ordinary shares and they told 25 cents each. So 140,000 into 25 cents will be 35,000. And 35,000 preference share. Okay. So when you're having 35,000, remember, already you're having 70,000. Just give me an let me go back to point 2. The existing 70,000 are to be exchanged for a new issue of this and this. Okay, so existing from that means you have to deduct 35,000. Now 70,000 is becoming 35,000. Understanding? So minus 35,000 minus 35,000. Now new issue. This is the third point. What is the new issue? Let's go to point number 3. The ordinary shareholders are to accept a reduction in the nominal value of their shares from $1 to 25 cents and subscribe for a new issue on the basis of 1-for-1 at a price of 30 cents per share. So you see, here there's a reduction of for 25, but price is 30. That's why that difference is the share premium. New issue is how much? Whatever the ordinary share you currently have. Okay. That on your statement of financial position you have 200,000. Okay, so that 200,000 we are talking about. On that 200,000, they will accept 25 cents reduction from $1 to 25 cents. So 200,000. Don't go by this exchange of 140,000. That is when preference share was exchanged and became ordinary. That has nothing to do. When you're issuing new shares, this is taken from here. And now you are accepting a reduction, 25 cents. What is 25 cents of 200,000? It is 50,000 when you're issuing. You're accepting a reduction, right? 50,000. But now you will have an account in the share premium. Why? Because you are accepting a 25 cents, but it is for 30. So the difference is 0.05. This you multiply by 200,000 to find the share premium account. Share premium is just the difference between this and this, 30 and 25 pence, which will be equal to 10,000. So 10,000 is the share premium account. Coming to debenture interest. Let's go to that. Fourth one is the debentures. After that, the others are not affecting your shareholdings, okay? If you see, they are not affecting. So here, they had to accept 20,000 at 25 cents ordinary share, debenture holders. Okay. Interest is also to be increased to 9.5%. What is the current this thing? It is 8%. If you see here. Okay, on 80,000. So 25 cents on 20,000. Okay. It is agreed that the value of the interest is equal to the nominal value of the shares issued. The interest is to be increased and the repayment is due for 3. Further this one. Okay. So now, earlier it is how much? 8% of 80,000. Just remember 8% of 80,000. And when you're taking about this thing, remember the repayment date deferred for 3 years. And here, debenture hold. Okay, no, wait. Interest has not been paid for 2 years. So when you're taking the debenture interest, okay, they told that 20,000 shares. And then on that 25 cents will be 5,000. And for the share premium account, if you want to find the difference after it has increased, see on it, because they told interest and the nominal value of the share is the same. That means it will be 5,000 only, the interest with the increase in interest rate, 9.5%. But earlier it was 8% on 80,000. This is debenture for 3 years, so it will be 6,400 for 1 year. For 2 years, it will be 12,800. Because in the third year, what they did, they changed it. They increased the interest rate to 9.5%. So third year, you don't have to take the interest at 8%. At the last year, it will be at this percent, which is 5,000. So that means first year 6,400, second year 6,400, third year it will be 5,000. The interest. First 2 years it was with the 8%. Third year only the restructuring took place because they already told debentures they are deferred for 3 years. That means it's for 3 years. Understanding? So here it will be 12,800 minus 5,000. The difference will go to the share premium. Why? Why it will go to the share premium? Read the question. I know this is little confusing. Fourth one. Debentures are to accept because it became shares now. That's why it is a share premium. Share premium, that's why it is affecting. Debentures are now becoming ordinary shares. And the interest is as equal to the nominal value. That means 25 cents of 20,000 is the interest at 9.5%. Understanding? So now what else? Just take, add up all. Okay. So drop all the sticks and then we'll extend the line and add up the total. 560 shares, 140,000 35,000, 17,800. Okay, so when you're putting, it is the amount, the amount, not the number. So let's go and put it. Let's go and do it. 140,000 will be now your ordinary shares. Preference will be 35,000. Share premium will be 17,800. And what else? Your debenture. This will become 9.5%. And 89,000. Don't forget to add the 9,000 with this. So it is 89,000 now. Okay. And regarding your trade payables, how much it will be? Here also you can see interest payable. You see how I've calculated? From here you can get your interest. Rather than calculating it that way, you can just take your interest from here, and in that table where I took the interest, right, for the debenture, from here you can take. So your only payable current liability is this 1,112,247, because overdraft has been paid off in the first question, and 12,800 is also done, because now it is changed. No longer interest payable you will have, because that debenture is changed into equity holder. So only you have trade payables. Okay, so when you add up, okay, and see, it will not balance. Why? Because there's a little difference that is left. What is it? That will go under capital reconstruction account as a balancing figure, that is 1863. Because of this, now try to balance, it will balance, right? Add up all your equity and liability and see whether it is equal to your total assets or not. Now it will add up. Now the last question for this last part, just understanding 6. Advise the shareholders and debenture holders as to whether they should support this reconstruction or not. So let's do that. Before going to the third question, okay, here we ignored the profit and loss. Why is that? Why we didn't take? Because the question said here, the profit and loss account balance is to be written off. Okay, that's why we didn't include it there in the previous question. Now, advise the shareholders and debenture holders as to whether they should support this reconstruction or not. Whenever a question like this asks, remember something you have to calculate, even though the question is advice. Based on what? You have to put some numbers into it. Mostly ratios. So for AFM, you have to know all your ratios: profitability, liquidity, gearing ratio, your net profit margin, gross profit margin, asset turnover, asset test ratio. All these ratios you have to know. The formulas I've not included it here. Okay, make sure that you know them before you come to AFM exam. Some portion of it will be tested, especially in reconstruction questions. Ratios are very heavily used. Okay, so let's start with debenture holders first, because as we know that they are the ones who are going to be paid first. We have to see whether they will support the reconstruction or not. Okay, but before that, okay, we can do some calculation. Okay, as you can see, what happened in the previous reconstruction scheme? Can you tell me? Can you tell me what happened? Interest increased from 8% to 9.5%. Wouldn't this be beneficial for debenture holders? Wouldn't this be beneficial for debenture holders? Of course. But they have also extended the repayment date. Which is not so good for the debenture holders, but anyway. Remember in the question they have given you corporation tax. They have given you the profit before interest and tax. Yes, after depreciation, before interest and tax as 50,000. There's a reason why that number is given. Whenever some numbers like this is given, you must be thinking we didn't use this anywhere, we didn't use 25% tax anywhere, then why it is given? It is not given without anything. There is a reason. Whenever something is given and you have not used up that number, make sure that it is used somewhere else. Maybe it is used somewhere else, like this question. Maybe it was not used in the first two questions, but here you require it. Make use of those numbers. How? This in the ratios you can use it. To build up your answer, to get more points in AFM, make use of answers. Make use of numbers. Through this, you can find out something. What? Profit is given. You are talking from the point of debenture holder. Their only interest is interest, right? So can't you figure out what ratio is very relevant for this? Interest cover. Can't you find interest cover with the interest and the profit given to you? Why not? Why not? Profit before interest and tax divide by interest. Why can't you find out the interest cover? Right? So what is the profit? 50,000. What is the interest? You have to find out how. What is your new debenture now? Earlier you had 80,000. With that you had 9,000 more. So you have 89,000. But remember here this also increased from 8 to 9.5%. So calculate 9.5% on 89,000, which will give you 8455. So 8455 is your new interest. So this, if it is divided by 50,000, will give you the interest cover of 5.9, which is very good. You are having a very good interest cover. That means with your profit, how many times are you able to pay the interest? Remember, higher the interest cover, better it is. You are more safe. Your income is able to support that. With that, you can pay the interest, and still you will be having some leftover. That is the meaning of interest cover. The higher it is, the better it is. Okay. From the point of preference shareholder, I didn't write a full-fledged answer yet. I'm just explaining you the points. We'll come there. Now we'll talk from the point of preference shares, because they're the second in the list to get paid. If you see from their point of view, their investment became half. Earlier they were having 70,000. Now it went down to 35,000, because they've changed to 35,000 preference share and also equity shareholders, right? But that means they will have a share also in the company, because they are having equity shares also. How much? How much of the ordinary shareholders are they having? Can you find out? Definitely you can find out. How? Through that table we have created before. Finding out this is divided by number of share, which is 560,000. Okay, so in terms of proportion, if you want to find out, just divide this amount by the number of share. So it will be 140,000 shares divided by 560,000 number of shares, which will give you 25%. So in terms of percentage, the preferred shareholders have 25% of ordinary shares. 1/4. Not only this, in addition to this, they have an increased dividend rate also. Okay, increased dividend rate is also there, and they do not even have to contribute any capital further. Okay, coming to the ordinary shareholders, we want to know how much they have retained of the company. How much? Tell me. Just give me a minute. Okay, we'll go through this again. Okay, how much they've issued, the ordinary shares. You have to see that over your total amount or over your number of shares. 200,000. 200,000. Okay, or you can read from here also if you want to read it from the information. You can read it from here that they have a subscribe for a new issue, because your new issue only will affect, remember, whatever you have previously. Even if you have exchanged preference to ordinary, it will not affect so much. If you want to find the standing, how much shareholders, ordinary shareholders have retained, you have to find out how much they have issued, new issue. So new issue is 200,000, right? In terms of number of share, they have issued 200,000 new shares. So 200,000 divided by total number of shares 560,000. Okay, what is the percentage? In terms of percentage, it is 36%. Okay, so they retain part of their stake in the company if they participate. Okay, 36% without any further cash investment. The further cash investment required of 50,000 leaves them with the majority holding. They still have the majority holding. Now we will find out the EPS, because for ordinary shareholders we want this ratio. You should know what ratio to find for what. If it's for debenture or any debt holders, interest cover or gearing ratio is more suitable. If it is for ordinary shareholders, earnings per share is more suitable. Okay. For preference shareholder, we do not have any such ratio. But yeah, EPS. To find EPS, start with profit. Profit is given as 50,000. Deduct your interest because it is profit before interest and tax. Your interest is, we just now calculated it, 8455. 41,545. Take 21% tax. I told you, you have to make use of this, which will be 8724. Okay, which will be 32,821. Now, deduct your dividends, which is your preference dividend. How much? You have 35,000 on that 8%, which will be 2,800. This much will be available to equity holders. Which is 30,021. In terms of EPS, if you have to find out earnings per share, then it will be earnings is 30,021 over shares. How many shares? 560,000 number of shares, which will give you 5.4 cents. 5.4 cents. As the shareholder would receive nothing on a liquidation. See, if you liquidate, shareholder would receive nothing, most probably. Okay, but at least in this restructuring, through this reconstruction, earnings per share is 5.4 cents. Understanding? So from this point of view, you can say this is reasonable. This reconstruction is reasonable to the shareholders. But this is just a brief. Now you have to write a full-fledged answer. How do you write? From the exam's point of view. Whenever you're writing it, always name the person, shareholder whom you're writing about. You start with any order you can write. Let's say you're talking about ordinary shareholders. You have to put a subheading, keep some space, write for it, then preference shareholder. Write in bullet. Don't write in bullet points. Write in paragraphs. And debenture holders. I'm not going to write the full answer, but I'm going to write in points. Make sure that you write it in sentences later on. I will just tell you the main points. Okay. Whenever you're writing the impact, right before reconstruction, what they are receiving. After reconstruction, what is the impact? If you see after reconstruction the position is improving, it is advisable that reconstruction is good. Otherwise, it should be rejected or it needs to be changed. Okay. Overall, you have to tell the impact. Okay. So before reconstruction, what is the situation? 100% before reconstruction, 100% voting rights and control was with them, isn't it? Is it or not? 100% was with them. But after reconstruction, what is it? Their control will be diluted, right? Because preference shareholder is also having a stake. Debenture holders are also turning into ordinary shareholders. That means they're also going to have stake. So their 100% is reducing to what? You have to find that percentage. Okay. How much? How will you know then how much it has been diluted to? You had earlier 200,000 shares. You had issued 200,000 new shares, whatever the price is. So total now you have 400,000 out of that 560. So this will tell you how much it has been diluted. 400,000 out of 560. How much? 71.4. That means now you just have 71.4%. From 100 to 71.4% it has been diluted, right? Use this word diluted. Are you understanding? Again, I will take you through because I'm sure most of you will not understand the new share issue. Okay, it has been told here. The fourth point. No, the third point. That they subscribe for a new issue. The ordinary shareholders. They're accepting a reduction in the nominal value, but we don't care about the nominal value and all. We want to know number of shares, right? We want to know the number of shares that have increased. Earlier it was 200 in the statement of financial position. Now another 200 because it's 1 for 1. Whatever 200 you have, again on 200. You understanding? So that's the thing. Whatever the rest happened, each ordinary shareholder is redesignated as a share of 25 cents will not have an impact on your number of shares. Fourth, the second point, that this 70 became 35,000 preference and 140,000 ordinary shareholders will not increase your number of shares. This will also not have an impact in your shares. The dilution will only come when you issue new shares. The ordinary shareholders issue new shares. Then only dilution will come. That's why we included this 200 with the previous 200. And the other things did not take place into account. Right? Other things will just add. You have just put in that table, but it will not be added with your 200,000. That's why 200 plus 200, 400,000 out of 560. Right? It's always like that. Always check the share issue for the ordinary shares. How many new shares they issued. This only will have an impact in your dilution of shares. How much your control diluted. Just give me a minute. Okay. So now. But still, even the 71 point, at least 71.4% control they have. That is also not less. Still, right? Assuming that they take up their rights. Okay. The issue that you have issued, they should take up their rights, then only, otherwise no. Then these shareholders might be unwilling to take up their rights given that the company is failing. But clearly, if the company cannot raise any new finance, it will slide into liquidation and the shareholders will receive little return, shown in the first part of this case. See, now you're talking about the willingness or unwillingness of exercising the right. This also you can include in your answer. Depending on the scenario. If it's a loss-making thing, more likely they will not accept this. Because it's a loss-making, why would they want their share ownership to dilute? Right? So in this case, they are saying they're unwilling to take up their rights. In this case, they're unwilling. Why? Because of the losses. Because the company is failing. So this should be the key consideration of the ordinary shareholders, whether they will accept or not. Remember, if they don't accept, okay, the reconstruction, they may well end up with nothing. So at least getting something is better than getting nothing, no? But accepting the reconstruction means what? They can keep the control of the company. Even though dilution ownership reduced, but they can keep the control of the company and will benefit in the future if the performance improves. So in this case, tell me, what do you think? One conclusion you have to give, final one-line answer, whether it's beneficial or not, whether they should go ahead with the reconstruction or not. This you have to give for any stakeholders, even in your AFM exam, don't worry. So on the balance, it appears that the scheme is acceptable to the shareholders. In this case, it is acceptable. It's more acceptable than not acceptable. So in your case, you might be asking, ma'am, how do I decide? See, you think logically. Receiving nothing is better, receiving something is better. Something is better, no? To reconstruct, at least you will have something. But if reconstruction is not there, you will receive nothing. You have a chance of receiving nothing if it goes into liquidation. Coming to the preference shareholder. Okay. Tell me. Same pattern. Before reconstruction, after reconstruction. Before reconstruction, they were guaranteed 5% of 70,000, which is 3,500 per year. This much return they were guaranteed. After reconstruction, what happened? It was 8% on 35,000, which is 2,800. So looks like they will be unhappy with this because now they are receiving even less. But remember, there are two other factors that makes this scheme more appealing. What are the two factors? Number one, number two. Number one, now they will also own ordinary shares, no? Some ordinary shares they will still own. So if the company performance improves, that means they will receive more dividend or not, they will receive more dividend. Second, what is the second thing? That if the company goes in liquidation, okay, ordinary shareholders might not receive anything, but preferred shareholder compared to ordinary shareholders are less risky. At least they will receive something. More or less does not matter. Something they will receive at least because they are second in the hierarchy. You understanding? So on the balance, this is acceptable to preference shareholders. So I'll just put a tick mark. You can write it on your own. But this is acceptable to preference shareholders. Coming to the third, debenture holders. Tell me. I'm not writing this answer. You are writing this answer. But I will tell you the points regarding interest. We have to talk about interest because interest only changed. So what can you talk? No interest for 2 years. No interest has been paid for 2 years. So they are waiting. This is not a good thing. Okay. So what could they do? They could apply to the courts to liquidate the company. No, debenture holders could do that according to part 1 of this case. So if they go by that, they will receive a full settlement. Remember, court will give them the full settlement. But in this case, reconstruction could be appealing. How? Even though in the short term they are foregoing the interest. Think about the long term. Think about the long term. They offer two things. One is ordinary shares. That means now they will have an ownership. So company performance improves, they will benefit. They will get a dividend. Second, higher interest. As I told you, from 8 to 9.5%. Isn't it? So these two things are beneficial. So from their point of view, what do you think? What would be your conclusion? See, if the debenture holders are not struggling in the short term with cash, they could wait for little, sacrifice on that short term interest and go for the reconstruction, because in the long term they're going to get benefit. No, one is dividend if company performance improves, and one is a higher interest, right? But remember, if debenture holders have short term issues, they cannot wait for the long terms when company performance will improve, when interest rate will be higher. In that case, liquidation is a better option for them because they will receive from the code, right? Because if they go by that, they go by the code liquidation, they will get all their claim, whatever they have claimed, they will get the full amount. So the answer could be in any direction. You can write it in any direction. It depends on the issue of the debenture holders, whether they have short-term issues or not. Okay. Now we'll be doing the next question. Another reconstruction question. This is not the same question, another question. So let's do that. Test your understanding 7. So in this question, okay, it's a computer manufacturer. They have incurred a loss of 160,000. Now they have proposed a scheme of reconstruction. Okay, so you have been given the statement of financial position and some notes. Okay, so let's go through the notes. If the company was liquidated, all of the assets could be sold for their book value except for inventory. Following a review, it was discovered that 220K, that means 220,000 of the inventory is obsolete, but the remainder could be sold for the book value. In addition, 90,000 of the receivable is irrecoverable. To be successful, a scheme of reconstruction would need to raise 195,000 of cash to invest in new manufacturing process. Given that the risk attached to the company, any providers of new equity capital will require a return of at least 18%. Current interest rate is 8%. 6% on overdraft, bank loan is secured. Now this are the following four schemes. Okay. The first, nominal value of each existing share will be reduced to 50 cents. Second, Goldweed Bank, who provide both the overdraft and loan, will convert half of the overdraft to one-third of the loan into a total of 200,000 new shares. New finance of 400,000 will be raised for a venture capital company who will buy new shares for this much, 1.25 per share. In addition to investing in a new manufacturing process, the finance will also use to repay the payables. This finance will also be used to repay the payables. Following the reconstruction, it is expected that the company will generate 320,000 of profit. See, whenever schemes like this is given, follow the order it is given. Start with the first, then second, then third, then fourth. Okay, following this order only. And I know it's little confusing. That's why I deal with one reconstruction scheme at a time. Okay, not everything together. When you're working with the shares, you're just working with the shares. When you're working with the venture capital, you're just working with the venture capital. And wherever the changes needs to take place, go and change those places. Okay, now following the reconstruction, it is expected that the company will generate this much of profit before interest and tax per year. Following the reconstruction, after reconstruction, tax is payable at 28%, assuming no tax losses. You have done a similar question to this, so this should be easier. We are required to do these four things. A, determine how much each of the original investors are likely to get in the event of liquidation. That means before reconstruction, how much they are going to get. Second, following the reconstruction, calculate the expected EPS, return on equity, to the venture capital company, and advise as to whether the venture capital company is likely to invest or not. This is from the point of venture capital. Two things: expected EPS, return on equity, and advice. C, from the post reconstruction EPS calculation above, calculate the effective return that the bank is likely to receive on the capital converted into equity. And D, determine whether the existing ordinary shareholders and the bank are likely to accept this scheme. It's very important. This question will always be asked, whether that person will accept, whether this person will accept the scheme or not. You always have to be ready with this answer and the calculation, of course. So first is in the terms of liquidation, how much they are going to get. This is before taking reconstruction into scheme. Okay, so that easily we can do. Okay, we can just go and do the changes in the statement of financial position here. Or I will just do somewhere here next to it. See, in terms of liquidation, you will be having assets to distribute, right? These are the assets that you have to distribute. You first start with the statement of financial position. Per statement of financial position, how much? This total assets 1755. 1755. Then less inventory write-off, because they have been obsolete, right? So deduct them. How much? Less receivable and less inventory write-off. Here 220, because this is when the company is liquidated. Okay, without taking the reconstruction, the first point you can take for the first requirement A. So 220 of inventory and 90 of receivable needs to be written off. That means deducted. Minus receivable write-off, which is 90, thousand and 220,000. The net figure is 1445. Now you distribute from here your assets. Remember, first will be the secured bank loan. How much? Because they told it's secure. There's a reason why they told it's secure. In the event of liquidation, the sources, the debts which are secured are going to get paid first before the unsecured. So loan is 1,200. This is secured. Okay. After that, you have 245. From this 245, what is your unsecured debt? Payables and overdraft. Your payables and overdraft are here, 205 and 200. Which is 405. If you see, it's more than what 160 loss. So what can you say from here? Unsecured creditors, how much they can get? They will only receive up to this much only. They have to receive 405, but they will only receive 245 max. Okay. So if you calculate it in terms of percentage, 60%. 60% of the amount owing only they will receive. 40% they will not receive. That means for ordinary shareholders, there's nothing. Ordinary shareholders receive nothing. That is what you have to write. That is for part A. Coming to part B, post acquisition reconstruction EPS, you have to find out, right? So when you have to find EPS, always start profit before interest and tax. That is your starting. So for part B, profit before interest and tax is how much? They have given you, right? Here, 320,000. So 320,000, deduct your interest. How much? How much will be your interest? Bank loan is for 1,200. How much is the interest? You have to see from here. Sorry, down. What is the interest? 8% and 6% on the overdraft. And overdraft is how much? Overdraft is 200. Let's do both simultaneously. Okay, OD. 600, sorry, 200 into 6% into 8%. But remember, you have to take a proportion. Why proportion? Because they told Godwing will will provide both overdraft and loan and will convert half of the overdraft and 1/3 of the loan into equity shareholders. 200,000 new shares. That means there'll be shares. They'll not be debt. So half of overdraft is debt. Half, that means overdraft remaining is only half. 1/3 will be converted into new shares, means only 2/3 will remain as loan. You understanding? So you have to take a proportion also now. Forward half is equity and half is overdraft. For this, 1/3 will be equity and 2/3 will be loan only. So if you are taking interest, it will be 64 here. Here it is 6. Profit before tax will be 250. Take your tax at 28%, which is 70, which will be 180 profit after tax. But that is not enough. You want EPS, remember. Earnings per share. You got your earnings. But what about shares? Post reconstruction shares you have to find out. So number of shares post reconstruction. After reconstruction, what is your number of shares? Start with your existing shares all the time. That you will get from your statement of financial position. That is 200,000. Okay. So it is 200,000 plus. Remember, from bank, 1/3 of the loan will be converted to bank. How much is the loan? Bank loan is 1,200. So 1/3 will be how much? Will be how much? 400,000. No, but wait a minute. Just in a total of 200,000 new shares. Already they have given you the number of shares, 200,000 new shares. So you don't have to take 2/3 and then you don't have to take the 2/3 of the loan and find the number of shares. It is 200,000 shares. And then from venture capital, how much you are going to get? Tell me. 1.25 per share. Okay. So now, first we'll add that 200,000 also here. This is from the bank. Okay. Then from venture capital is how much? 1.25 per share. Okay. We'll read this again. New finance of 400,000 will be raised from a venture capital company who will buy new shares for 1.25 per share. In addition to investing in a new manufacturing process, the finance will also be used to pay the payables. Repay the payables. Okay. Let's go and check the payables, which is 205. Something which is I'm working out on it, because the answer that is given to you, let me tell you, it is 320,000. Okay, I'll write it here so that you also can find it out. 320,000. So the total number of shares will be 720,000. Okay. Now EPS, if you want to find out, it's very easy because earnings is 180. Number of shares 720,000, which will give you 25 cents per share. You also have to find out return on equity, ROE. I will come back to this later. Let me finish this first. So return on equity will be how much? Return on equity to venture capital company. that is earnings per share. Okay, here who will buy new shares for 1.25 per share, 1.25, and this is 25 cents. So if you see, it will be 0.25 divided by 1.25. You're changing this cents into dollar, or you can change this into cents. It could be 25 cents divided by 125 cents, or $0.25 into $1.25. Anything. It would be equal to 20% only. Right? So if you see this, what is the target return? At least they require a return of 18%. Okay? But they are getting 20%. So this will be acceptable to the venture capital company. Correct? What is the requirement for so B is done? A is done. Because they told advise whether they are likely to invest here or not, the venture capital. Yes, you will advise them to invest. Why? Because they are getting a return 20%, which is more than the least return, which is 18%. Okay. Same for C. You have to take EPS and you have to take effective rate. This is from the point of bank now for C. But before going to C, we have to find out that venture capital shares. I told you, right? To stop there. When we are finding the number of shares, we again have to work out on that. You cannot leave it like that, because these are little areas where we often make mistakes. Okay, it's here. The fourth point. Following the reconstruction, it is expected that the company will generate 320,000 of profit before interest and tax. Following the reconstruction. No, but that's a profit. They're also getting 320,000 for venture capitalist. This is for the shares we are talking about. $400K, and they will repay payables of 205. So 400 minus 205 is 195. We have to refer to the third point. Share is 200. If you go by 200 into 1.25, it will give you 250. So just give me some time to work it out. This is regarding number of shares. Okay. So new finance of 400,000 will be raised from a venture capital company. They will buy new shares for 1.25 per share. In addition to investing in the new manufacturing process, the finance will also be used to repay the payables. Okay, so I figured it out. How you got 320? Because they told new finance was 400 and the price is given 1.25 per share. You have been given the amount and the price and you have to find the number of share. So you will be dividing 400 by 1.25. You see how you have to have a strong presence of mind in your exam. We have been multiplying it wrongly. Rather, we had to divide it, which will be 320 number of shares. That's how you add 320 shares here. Right here. That means 320,000 shares you will get it from the venture capital. Okay. Now, let us move on to part C of the answer. Effective return to bank. Okay. You have to find out. So part C. When you're finding it, okay, what is the capital that they have forgone? Capital forgone. That means when it's converted to equity, okay, they will not get this amount of capital. Let's read the requirement again. Effective return that the bank is likely to receive on the capital converted into equity. Understanding that means they are going to forego the capital now that they are going to receive by having that debt because it's now going to be turned into equity, right? For that you have to refer to point number 2. 1/3 of the loan and half of the overdraft. How much is the overdraft? Overdraft is 200. So they are going to forego half of this, half of the 200. Capital forgo half of 200,000. The overdraft plus 1/3 of the loan. How much is the loan? 1,200,000. And the total will be 500,000. Okay. What is the number of shares in exchange? They are foregoing the capital, but they are receiving shares in exchange of that. What is that number of shares in exchange? We have already calculated it, I think, above, right? Here, 200,000 from the bank. Now, earnings. What is the earnings? Tell me. Number of share, that is 200,000 into how many? There is no harm in going to your requirement multiple times, okay? In case you forgot, you don't have to memorize it. Remember that. Okay? So in this case, it is how much? 25 cents. Why? Because earnings per share is 25 cents. Okay, exactly the mistake that I did. You will be doing it in the exam. Don't do it. Because in B, we have already found out the earnings per share, that is 25 cents. So with this earnings, just multiply your earnings per share. That's it, which is 25 cents. What did I do? I tried to find out where did we get that 25 cents. Because in the answer it is given 25 cents. That's what you would be doing when you are doing this question. Don't do that. The previous question, it will always be related to your previous paths, okay? If you're having a question in different paths, like this, A, B, C, D. So this will give you 50,000 earnings, $50,000. And what would be the return? You have to find out the return. That means in terms of percentage. Okay, to get that, okay, it's very easy. What is your earnings? 50,000. And out of what? Out of the capital that you have forgone. That is this 500,000. That is 10%. 10% return you are getting. Only 50,000 out of that 500,000, because capital forgone means that became your shares now. So out of that 500,000 shares, 50,000 your earnings or return on earnings or return on equity, you can say, is 10%. Understanding? Return on equity, simply it is the meaning of return on equity only. Now coming to part D, acceptability of the scheme. To the existing shareholders, ordinary shareholders. Tell me. If the company is liquidated, okay, we saw in part A, nothing they will receive. But what if reconstruction takes place? We have to find out this. Okay. How much control are they losing? And how much they're owning? Okay, they will own how much? Let's say. See how many shares now they have after reconstruction. We just calculated it 720. Out of that 200,000 is your ordinary shareholders. Right? Already we have calculated this. So 200,000 divided by that 720,000. Out of 720 to 200,000 is the ordinary shareholders only. Okay, so they are having how much? 28% only. They are owning 28%. And they are likely to earn how much? Earnings per share? 25 cents. So based on the original nominal value of each share, this represents a return of how much? Original was $1. Now you are getting 25 cents. If you have to see it in terms of this one, 25 cents divided by 1, you are getting 25%. For each share, you are getting a return of 25%. Now based on this, you decide. So given the return, okay, at least you are getting 25%, no? Only you are receiving nothing. So this looks more better. The scheme looks more better or not? It looks better. It looks better. But remember, now you have venture capital and bank also in the ordinary share capital, and they have a bigger percentage. You only have 28%. So they might want to amend this so that the less benefit goes to the ordinary shareholder and more benefit comes to them, because now they have a bigger percentage, no? So in that case, this might not be beneficial for the ordinary shareholders. Understand this. If they amend, this might not be generous. Coming to bank. Okay, venture capital, we don't have to talk about it because we already spoke in part B. They already asked whether it will be acceptable to them or not. So bank. What about bank? If reconstruction was not there, how much bank would have been receiving? Like if the company was liquidated, how much bank was receiving? Full amount, right? That 1,200 they are receiving that full amount, right? Remember in part A? But they will only recover 60% of the overdraft. For overdraft, only 60%. But for the loan, full amount they are receiving. If the company is liquidated. This in part A we told. But after reconstruction, what happens? The bank is going to get a return of 10%. This is in part D only we showed. Sorry, part C only we showed you. Okay. They will get a 10%. and they will continue to receive interest on the remaining loan. Remaining loan, they will receive interest and overdraft. So what do you think? This is acceptable or not? Likely to be acceptable or unlikely? See, 1/3 of loan is converted into equity, okay, secured loan. And the focused return on this is only 2%, more than the current loan interest. This is unlikely to be acceptable to the bank. Understanding? Again, I will repeat. The 1/3 of loan that is converted into equity, okay, focus return on that is only 2%, more than the loan interest. Only 2%, not so much. Difference is not so much. So this will be unlikely to be acceptable to the bank. If the difference was so much, yes, we could say okay. Because we have already seen the return, right? What was it? 20%. They expected 18% return, but they're receiving 20%, only more. We could see in the question here. That is the questions here. Where is that? Here. Given that the risk attached to the company, new providers of new equity capital will require a return of at least 18%. So for the loan interest, you are receiving at least 18%. Now you are receiving 20% after you've converted into equity. Only 2% more. Okay, and here if you see for the venture, oh sorry, that is for the venture capital. But here if you see the current interest is 8%. But your return on equity is only 10%, 2% more. So that's it. Now we'll be doing the last final question. This will be done on Excel. Before we conclude this lecture and go to our last lecture on reconstruction, that is business reorganization. Test your understanding 8, the last question for reconstruction, and this is very much like your exam standard question. So please pay attention to this one. If you have not paid attention to the previous one, it's okay. With this one, we are going to conclude this lecture. And this will be done in Excel. But make sure when I'm doing it in Excel, you have the question in front of you. Okay, now let's start. So here in this company, you have been given the statement of financial position. As you can see, some information and the requirement. First, we are going to start with the requirement. Estimate the impact of the two proposals on the next year's forecast earnings and financial position. Very much in your exam, a question like this is going to be asked. Part B, evaluate the decision to sell the training business unit. Evaluate means you have to talk about the pros and the cons of selling, and advise whether if either proposal should be accepted or not. Two requirements in one. Okay, regarding other information, the training business contributes 10% overall after tax profit, pays tax at a rate of 20%, and after tax return on the publishing is 8%. After tax return on advertising investment is 13%. Non-current liabilities are at fixed rate of 6%, okay, such as bank loans. Now, after tax profit is 15.6 million, and you have been given here. Ray Company is a company with a diversified range of business units. One of its business units is a training business, is underperforming. The finance director estimates that this business units could be disposed of by selling its non-current assets for their book value of 25 million. At the reason, they have come up with two proposals, okay, for the use of this 25 million proceed. Once they sell this, how they are going to use this 25 million proceed, like selling the non-current asset. Proposal 1, use half the proceed, that is half of 25 million, okay, half the proceed to pay off some debt finance, and other half to invest in some non-current assets in the existing publishing business unit. Proposal 2, use the full amount to purchase some new non-current asset and set up a new business unit in the advertising industry. At the end of the board meeting, the finance director was asked to prepare some calculations to show the likely impact of these two proposals on the statement of financial position and forecast earnings. Okay, so let's do this question on Excel. So now we are going to do test understanding 8 in spreadsheet. Okay, you have to open a blank workspace from AFM, and then we are going to go to spreadsheet. Okay, so first we are going to show the impact on statement of financial position and earnings, and we are going to use the tabular method. Okay, this is how we use the tabular method. So you need to write that this is for part A. Okay, you need to clearly label. Remember, you need to double click so that you can write on the Excel. You need to clearly label for which part you are doing. This is part A. Okay, impact on state. You can write short form for statement of financial position as SOFP, and earnings. Okay, so I'm going to drag the cell here. I'm going to make this bold so that it stands out, right? I can even increase the font of this if you want, 12. Okay, so I'll just keep it 11. I think it's not too small for you, all right? I hope it is visible, you guys can see it. Okay, now earnings. Okay, here always start with the current. Even if the current is given, you have to still write the current before writing the two proposal. Then you don't have to write the name of the proposal, you can just write proposal 1, proposal 2. Okay, proposal 1, drag this, and proposal 2. Okay, I'm going to make this all bold because these are the headings. Center align. Make sure that you keep enough space. You can drag the column so that you can make it wider so that you can write on it. And here this needs to be the biggest because here you are going to write the description. Okay, the types of earnings. So we start with after tax profit. Okay, or profit after tax, PAT you can write. Okay, it is given as 15,600 and it will be 15,600 in all the other two, in all the three cells. 15,600, 15,600. Okay, now remember, if you are losing any of the revenue, you have to deduct it, and if you're earning any revenue, you have to add it. Okay, so for the first one, it is profits foregone, okay, that you have given up by selling training business. By selling training business, how much? 10% you are going to lose. Okay, if you think that everything cannot be seen in this cell, make sure that you drag it to the max you can. Okay, so the first one, they told that training business contributes to 10% of the after tax profit. Okay, and you're going to sell that, right? From there you're going to get 10%. 10% of what? After tax. Okay, current there will be no impact, but for both proposal 1 and 2 it will be by 10% because they didn't mention whether it will be for proposal 1 or 2, so you have to take 10%. It comes under other information. Okay, remember the on the other information there are 3 bullet points. The first one, it says the training business contributes 10% of the company's overall after tax profit. So when you're taking 10%, okay, just put, you can just write equal to, you have to enter the equal to sign. because you are taking 10% of the number. 0.1 multiply by this number, enter, and you can drag it to this cell. It will be same. But remember, this needs to be deducted, so you have to make it a minus. How do you make it a minus sign? Just after the equal sign, just put a minus and enter. Same do for this cell. Just put a minus, enter. Okay. Do not put bracket, because if you put bracket, it will take it as a text. It will not take it as a number. Because in this Excel, the Excel that is there on a CB platform, it has been formatted in such a way that negative numbers will be denoted by a minus figure. Okay. Now what else? What's next? Tell me. Interest that you are saving. Interest saved by paying off debt. They told that they are going to pay off debt. So you are saving interest on that. Right? Next will be interest saved by paying debt. Okay. It is for proposal 1. Because they told half of the process will be used to pay off some of the debt. But in proposal 2, you are not doing that. You are just buying full non-current assets. Only in proposal 1, it will have an impact because you are paying half of the debt. You understanding? And what is the interest rate? For bank loan, 6%. 6%. And what is the amount of the debt from your statement of financial position? Non-current liabilities? Only half of it will be used to pay. Okay? Use half of the process to pay off some of the debt finance. And other half, that is 25 million is the receipt, this one, proceed, right? From the 25, 12,500 will be used to pay the debt. You understanding? So here you can show that amount. Okay. You don't have to show it here. You can show it under proposal 1, equal to. Okay. Put a bracket. 12,500. Okay. On that, multiply 6%. Because 6% is the interest. Remember, after tax. Okay. How much is the tax? 20%. So after taking 20%, that means after tax it will be 80%. So you can just directly take 80% or 1 minus 0.2, anything. I will just take 80%. Enter. 600. Right? It's an interest saving, so you have to add, no minus. Next. The moment examiner clicks on the cell, your working can be seen here. So you don't have to write that working anywhere else. Understood? This saves time. Now, any extra return that has been generated. Extra return. Okay. Extra return will be generated in both proposal 1 and 2. But it is different. The way it is generated is different. Starting with proposal 1. Okay. How? How are you going to get the extra return? Tell me. Because they told half you are going to pay debt finance. Okay. But with other half, you are going to invest in non-current asset. When you invest in non-current asset, you're going to get that return also, which is 8%. 8% is the return. You understanding? So 12.5 here equal to 12,500 into 8%. Enter. And for the proposal 2, okay, it will be this extra return is 8% on publishing investment. 8% on publishing investment. This extra return, which is for proposal 2, is on advertising investment. How much? 13%. For advertising agency, okay, it is 13%. 13% of what? On 25 million, the full amount, that full 25 million they are using to invest on this. So it will be equal to 25,000 multiplied by 13%. Okay, now adjusted profit after tax. This is what it is known as. So just take the sum function, take all this cell even if it's empty so that you can drag it to the other cell, close it. Now just drag it to the other cell. You see, this saves a lot of time. This is what I call time saving. You need to be very smart. Rather than every time doing some function, you can just copy paste it to the other cells. Change. Okay, the change, if you want, you just have to find out the difference. From here, from current to proposal 1, how much? This minus this. Enter. You see? And this is plus 40. And here, if you want to find out the difference, this minus current. Not the proposal 1 and proposal 2. Proposal 2 minus current. You have to compare with the current. 1690. There's an increment for both proposal 1 and 2. It increased from the current position. Okay? And the higher increase comes under proposal 2, if you can see. Okay? Now, this is not over. This is just with the earnings you have showed the impact. This is how you show the impact in the exam. Now, you have to show the same way but for the statement of financial position. Okay, let's start. Okay, let's go down and do the same thing. Statement of financial position. I'm going to make this bold. Same way, current, proposal 1, proposal 2. Okay, I'm going to center align them and make them all bold. Now I'm going to write all the items. And make sure whenever you're doing this question, time yourself and see how long are you actually taking to do this question. And make sure that you enter very fast, okay? Your typing speed has to be very fast. So NCA, I'm using short form in order to save your time. Non-current asset, CA is current asset. Then we have TA, which is total asset. Then leave one space. I'm going to write ENL, equity and liability. Share capital, reserves. This I'm going to make it bold. Then we have, which is known as total equity. Okay. Then we have non-current asset NCA, non-current liability, sorry, NCL, and then current liability CL. Okay, and it has to balance. It has to balance under all the three conditions. Starting with non-current asset for current, it's already given. Just take the figure 92,650. First, finish off with the current 16,250. Sorry, 16,620, and just take the sum function of this two. Enter. Or you can just write what it is, but it's better to take the sum function so that you can drag it to the other cell also, other two cell also. $92,650, but there is something wrong. 16,620, 92,650. There is a mistake somewhere. Okay. Yes, the mistake is here. This has to be 16,620. Okay. Now, share is 50,000. This is 2550. Okay. Again, you can use the sum function. Then we have 30,000 and 8720. Use the sum function. You start from here, total equity, and add both liabilities. Undo. Okay. Remember to put equal sign, sum function. Remember to add with the total equity and the current liability and non-current liability. So if you see here, it is balancing this and this. 109,270. Now we are going for proposal 1. Proposal 1 will affect your assets. But wherever the effect is not there, you can quickly write it. For example, here, just copy paste it. Copy, paste, because no effect. Okay. Share capital also will not change. But for proposal 2, you can work simultaneously if you want, if you can, or you just finish with proposal 1 first. We'll first finish with proposal 1. Here 50,000 because no change in share capital. Okay, reserves will change no matter which proposal you are using. Non-current will change, but current liabilities will not change. So wherever the changes will take place, first finish it off. They told half of the non-current liabilities will be paid. Okay. And other half will be used to buy what? Non-current liability. First, let's read proposal 1. Use half the proceeds to pay off some of the debt finance and other half to invest in some new non-current assets. How much do you think should be non-current assets for proposal 1? $12,500, exactly. 12,500 you have used for current. So here, from here you have to deduct 12,500. Enter. You see, your non-current assets will be reduced. And here, you can just take it to this cell. When you take it like that, automatically they will perform the sum function. You see? Sorry, when your current assets changed. Okay, we'll see later how. You can go up. Okay, this anyway. Coming to reserves, how much should be your reserves? Remember, when you're taking reserves, you can only take the change. This change only you can take. Copy, paste. When you are copy pasting it, you can just cannot copy paste it because it has a formula with it. So you have to go to paste special. You can just paste the value or with the formula. So let's place with the formula. Okay. So the moment you click this 40, they can see the formula here. How you got that 40? I always say click it with the formula. That's easier, right? but it's an increment, so you have to add that 40 with this. Okay, wait, this here equal to this plus, you can either click that cell 40 or just write 40. Okay, and here again it will be same, share capital. Here when you're taking reserve, it will be this plus how much was the increment? 1690. Enter. You see? So automatically you can just drag it here. Drag it to this to cell. The sum function will be performed. Okay. For here, how much it will be? Deduct 12,500 from here because you're going to pay off. Enter. Okay, 96,810. But you can see it's not balancing. Everything is done, but the only place is this current asset. That's why this is not balancing. Why? What needs to get changed? Think. Okay, so until then, we'll start with proposal 2. Non-current asset will be this. There will be no change in that. And when you're coming to the current asset, there is a change. But we'll come to that later. Non-current asset, there will be no change. 30,000. Sorry, non-current liability. And this also will remain same. You can just drag it. Okay. But your total assets we don't know because we need to work out with the current assets. So what happened was when you tried to balance, okay, the current asset was the balancing figure. That's what happened. That's why this was not balancing, you see. So when you're trying to get it equal to this minus this, enter. No, wait. There is something just this need to balance. So when you're taking this, okay, it is simply the balancing figure. Just take this minus this, enter. You see, now it will balance. Coming to here, that's the same thing, equal to this minus your non-current assets, enter. 18, 3, 10. So simply current asset is here. Most of the time you will see current asset is the balancing figure, right? And hence just drag it here. You see, now everything is done. So what do you think, which proposal is the best out of the two? Looks like proposal 2 is better, right, in terms of statement of financial position also. So you have to analyze it now. Okay, there are some workings and no's that is given in the answer. You can write those workings, like how did you get it, how did you get the current asset, you can say it's a balancing figure, things like that. Okay, Now for proposal 2, okay, we told that we are going to get non-current asset. In the notes they have explained why they didn't increase the non-current asset, because they told that they are going to invest entirely the 25 million in non-current asset. Then why did they did not increase the non-current asset in proposal 2? See, the reason they did not increase is because you can reduce your non-current asset by 25 million by selling the training, but again they invested in advertising, so that means again you have to increase. So the effect is zero, right? The net effect will be, there's no impact increasing, reducing by 25 million. So rather than decrease then increase by 25 million, it's not worth it. So there is no effect. Understanding? There is no change in share capital and non-current assets, so they stay the same. Non-current liabilities, sorry. Okay. For proposal 1, what did we do? We reduced the non-current asset by 25 million. Then we increase it by 12.5 million to show investment in publishing. So basically what they did in the statement of the financial position with the figure, that's what they have explained in the notes. Okay. Now coming to part B. What was the part B's requirement? A is over. B was evaluate the decision to sell the training business unit and advise whether which proposal should be accepted. Now this you need to do it in word processor. You cannot do it in Excel. You have to write here. So when you're writing it here, you can write whatever the question is in the exam and then write part B for it. You can write evaluation of the proposal. Like this. The answer could be in two separate places. Part A could be in Excel, part B could be in writing. But remember, you need some of the numbers in your word also. So this is how you write. I'm not going to write the full answer. The answer is lengthy. I'm just going to give you the points and how to write this answer. Answer needs to be written in different paragraphs. Number 1, 1.1 paragraph needs to be separated by one line. Okay. So we are going to talk about the training business. Okay. Number 1, what is the main point? I'm writing it. Training business is underperforming. You have to always evaluate. You have to write. Okay. Reconstruction question, not always calculation. So it does seem sensible to consider disposing it off, isn't it? But remember, even if it's underperforming, how can you be sure whether it's for long term or not? It could be for short term also. So before you make a final decision, okay, you have to see what are the chances that this performance will improve in the future. Now we are going to talk about the assets and its investment and all those things. That means from the financial ground, you have to answer this question. Okay. So if you see that training business has non-current asset of 25 million, hasn't it? And if you see it is expected to generate return after tax profit of 1.56 million. And if you show it in terms of return, it will be 6.24%. That means 1.956 divided by 25, right? This is lower than the return on investment. How much you are getting the return on investment? 8%. So 6.24% is even less than that. So by this case, okay, the proposal to sell the training business and reinvest the profit looks better in terms of financial performance. Okay, let me tell you. Let me write these points again. Non-current asset is 25 million. Okay, and after tax profit, here 15,600. You see, For training business we are talking about. Remember, always talk about the current situation first. Before jumping into the proposal 1 and 2, first talk about the current situation. Non-current asset 25. Out of that, after tax profit 1.56 million. So if you have to calculate it in terms of this thing, you can take out your calculator. 1.56 divide by 25. Enter, which is 6.24%, right? But you can do it in Excel also. Anything is fine. Understanding? You can write a return of 6.24%. This is less than return on investment in both publishing and advertising sector, because in advertising the return is 13%, in publishing it is 8%. So compared to both the return, this return 6.24% is less. So it's better to sell this off rather than keeping it, because return is less. Now coming to proposal 1. So we'll continue in after 1 minute. So we are resuming back, okay? One paragraph for proposal 2, another paragraph for proposal 2, okay? For proposal 1, what are you going to write? Go again through the proposal 1 and see. If you see proposal 1, okay, I will take you to the Excel. Writing part you can do it. It's not my job, but anyway, let's take you to proposal 1. This looks unattractive if you see compared to proposal 2, right? It is not financially attractive, proposal 1. Because if you see the after tax profit, just see the change is just 40. It's almost same to the current situation, hasn't it? And also it's not very clear why they are paying some of the debt by the remaining amount from the 25 million, right? And even the interest rates are fairly low. The company's gearing is not very excessive. And the interest cover is high. See, to tell all those things, interest cover is high and all, they must have performed some ratios, which you have to do. Okay, how to cover interest, how to find interest cover? Simply take your interest, divide by your profit after tax. Sorry, profit after tax divided by interest. Okay, and find out on your own. This is your homework. So it's a question mark that if your interest cover is good, if it's high, you do not have a gearing ratio problem, then why should you pay your debt, right? We are talking about proposal 1. See, you having an excessive amount of debt is bad for the company, but having a moderate amount of debt is good. Why? Because you can have advantage of tax, you can have a tax relief on the interest payment, right? Now coming to proposal 2. Look at proposal 2. This is more beneficial, looks more attractive, right? Because earnings also expected to increase significantly, 1690, you see. And even the earnings, okay, in the advertising sector is 13%. We are getting a higher return there. That's the reason why earnings increase so much. So what could be the concern? See, even if everything is good, they told evaluate. Evaluate means the disadvantages also you have to give. Even if proposal 2 looks beneficial, what is the disadvantage of it? What could be the only concern? Is whether the directors have the necessary expertise to invest in this new sector. They are advertising, they are investing in advertising sector. Now they are in the publishing sector. So you have to take care whether they have the expertise in that sector or not. If not, it will be difficult for a company to achieve this high level of return. This is how you have to write your answers, okay? And finally comes your recommendation, your last para. Because they told you to recommend which method if the two is better. By now you also know it is proposal 2, right? But how are you writing this? I will write this for you and show you how to write a good recommendation. It's very important. You just cannot write, okay, recommendation, I recommend you to go for proposal 2 because that's the best. I recommend you to use proposal 2 because that gives the highest return. Right? That is not recommendation. You're telling them you have to do this. That's not recommendation. Recommendation means it's their choice, they can do anything, but you are giving them both the pros and the cons, and now it's their decision. But there are certain words that you have to know. It's like you trying to convince them, persuading them. You're not giving a decision for them. So be very careful when you are told to recommend. You have to use this kind of words. It's like you have to use more what do I say, kind words, right? You should not sound very offensive. So I will write this recommendation for you. You need to write it, and remember this, for any recommendation use this, okay? So as long as it can be shown that the training business under performance, as long as it can be shown that the training business underperformance is a long-term problem. You see, you have to use this kind of words. Make yourself familiar with this kind of words. When you are told to advise, recommend, give suggestion, this is how you recommend. These are the words you have to use. Just think in real life, how do you recommend to someone? What are the words? So write like you speak. It will be very easy for you to write it in that sense, okay? Normally how you speak when you recommend, see, these are the pros, these are the cons, but I would recommend based on my experience, or based on, that if you go by this would be better, and if you go by this, these are the consequences of it. So like this way you have to write, okay? But keep it very short. That's what I wanted to show you. That's why I want to write out this for you, because I wanted to show you how to keep your recommendation short. Always introduction, recommendation, your conclusion has to be short compared to your main body. That has to be the biggest. So it makes sense, okay? As long as you can show that this underperformance is not for short term. If it's for long term, then it makes sense to dispose this off, okay? You can use any other word rather than saying it makes sense. It's reasonable or it's advisable, anything like that. It makes sense to dispose of this business unit. This business unit. leave one line, go to the next. On balance, you see, overall you are saying, looking at both pros and cons. On balance, proposal 2. Remember, if you are running short of time, immediately write proposal 2 looks attractive because of this. So write like that. Okay, start like that. At least even if you don't have time to write at the end, at least you were able to point it out that proposal 2 is more attractive. Because sometimes what happens, students tend to wait till the end to write that proposal 2 is the best, and they don't get the chance to write it. Maybe they miss out the time. So if you are running short of time, don't write paragraphs and paragraphs and then write at the end and try to open the suspense. Okay, don't have this suspense thing that I will write proposal 2 at the end. Write it immediately. There's no harm in that. You will still get the marks. Proposal 2 looks more. So you're comparing proposal 1 and 2. So you have to say this looks more attractive. Looks more attractive option. But you have to give justification also why. You have to give justification. Given that it involves investment in a highly profitable industry, because they are in the advertising. Advertising is giving 13% return, which is high, right? That itself shows that this is a highly profitable industry. So that involves investment in a highly profitable industry and avoids the, because in proposal 2 you are not paying the debt at all. And avoids the unnecessary repayment of debt on the proposal 1. Because if you see proposal 1, the repayment of debt looks like very unnecessary, right? Because your financial statement of financial position shows you are in a good working condition. That means your gearing is not high. Also interest cover. Okay. So you see only 4 lines, not even 4 lines, 3 lines maybe. So this is how your recommendation should be, short and sweet. Short, and it should include everything. You should not exit beyond this. So anyway, and you can even copy paste, take some numbers also there if you want. So this is how you have to do a reconstruction question. Now let us summarize this whole lecture. So we started with options for solvent companies: debt to equity, equity to debt, equity of one firm to another, equity from debt of another firm to another firm. These are the 4 ways a solvent company could reconstruct. Option 2, the impact on stakeholders. You should always talk about the impact of reconstruction on stakeholder, any stakeholder, mostly venture capital if they are giving you fund, then the shareholder, the preference shareholder, ordinary shareholder, the finance holder, debenture holder, right? Assessing the impact of the reconstruction scheme on statement of financial position and earnings. This is a very important area. Sometimes they might ask you gearing position also, where you have to calculate gearing. I hope that you know the formula, right? You have to know all the formulas. And tabular method, which we use for showing the impact on the statement of financial position and earnings, where side by side, first we start with the current situation and then proposal 1, 2, 3, depending on how many proposals they are. More than 3 proposals, they will not give in the exam. Minimum 2, maximum 3. Okay, they might sometimes give you just 1 proposal also, but usually they give more than 1. Otherwise, how can you compare, right? Or sometimes they might just give you 1 proposal and say whether it is better to liquidate or reconstruct, things like that. So that's it for this lecture. Thank you for watching. Please do the questions, and see you in the next lecture. That will be the last lecture under reconstruction. That will be business reorganization. Thank you and best of luck for your AFM exam.